Hi, welcome back. Show's called Your Money or Wealth. Joe Anderson here. Big Al's over there. We're talking about different things that people are doing to sabotage their retirement. Simple steps that you can take to avoid them. Go to our website, yourmoneyorwealth.com. Click on the special offer this week. It's our retirement readiness guide. Get ready for retirement, folks, with our special guide. All right, let's see how you did on that. True, false.
$100 in 2000 is equivalent in purchasing power to about $180 today. So we're talking about inflation, right? More than 20 years ago, $100. If you're spending $100, you're buying the same amount that you have to spend $180 today. Is that true? It actually is true. That's at about 3% inflation, Joe. That's about the right number.
Do you think people had their calculators out?
I think so. I mean, they're just like me. Pulled it out.
Okay, looking at 1970, cup of coffee. So 25 cents in 1970s. Today it's a dollar. Well, how much is a coffee at Starbucks? Dollar? It's more than it's like $10, $5.
Well, it depends what kind you get, but just a basic coffee is probably at least $3.
Wow. All right. So here you go. A little gas and go. $1.85. All right. It was 25 cents in 1970. 2000 was $1. 2022, $1.85. All right, so if this is inflation, this is the cause of inflation. That's why when you think about investing, you're trying to combat this. Right? If you have all of your money in cash, you're just losing money safely. You're not outpacing inflation. So that is why the need for some of you to have a little bit more riskier assets such as stocks to outpace this.
Here's what happens. People, they retire at 65 and so they think, okay, I have another 20 years or more, and they're using today's dollars, not realizing the cost will be perhaps almost double in 20 years from now. Now, if you think about, Joe, if you think about required minimum distributions, there's a lot of miscalculations there. First one is not taking it on time, not even really understanding. And it is confusing because they keep changing the date on when you need to take it.
Yeah, how old you got to be? What's the date that you have to take it? Do I have to take it when I'm 70 and a half? Oh no, those are the old rules. Now it's 72. Is it 73? Is it 75? Get it a little confusing here. Just remember that you have to take it, but it's April 1st after your required beginning date. So whenever your required beginning date is, you do have until the following year to take that required minimum distribution. But if you do wait the following year, you have to take two.
You have to take two of them, right? And so just
clear as mud here.
Yeah, that we know. Another thing too, though, is like, okay, you did everything right. You did the right calculation, but you took it all out of one 401k. You got 4 401ks. IRS says you have to take a required minimum distribution out of each 401k. Now, if you have multiple IRAs, you can aggregate them together and just take one. 401ks are a little bit different. Right.
I mean, the rules here, it just needs to be simplified just a little bit. You have multiple 401k plans, you have to take an RMD after every single 401k. You have multiple IRAs, no biggie, you just have to take one RMD. You have to add up the total aggregate amount, though, as Al said. So calculate the amount wrong. Right? So if you don't take enough out, they're going to penalize you. First year could double RMD taxes. So this happens quite a bit with people that are really good savers.
It does, right? Because you didn't take it that first year where you turned 72 or 73 or 75, whichever year it is for you. You take it the following year and that's okay, but then you have to double up and take another one.
Another thing to think about is that you probably want to start calculating what your RMD is a lot earlier than when you actually need to take it. Because what you find is that for those of you that have big balances in your retirement accounts, your RMD might be quite large, which would push you into another tax bracket. Recently, I met a gentleman that had $8 million in his retirement accounts, $8 million bucks. He didn't spend anything. He had no idea what the RMD was going to be. Thank goodness he looked at it a lot earlier than his RMD age or his required beginning date, so then he could try to mitigate some of that tax by doing conversions or utilizing some of the tax brackets before a lot of this money comes out. All right, asset allocation.
Yeah, so this is another issue. So the concept is you got to have the right asset allocation for your plan, depending upon how much money you need out of your portfolio when you retire. This is not the concept that you need to be this allocation. It just means to say that as you retire, as you need to pull money out of your account, you need to make sure you have enough safe money so that if the market goes down, Joe, you can still take money out and be okay.
Now, this is the reason why, because it's sequence of return risk. This is one of the largest risks that people don't really understand. Because if you look at the S&P 500 or the Dow Jones or the total U.S. stock market over the last 20, 30, 40 years, let's just assume the average rate of return over that 40-year time frame is anywhere from, let's say, 8 to 10%. Let's just say it's 9% hypothetically. So 9% rate of return over the long term. Right? So you're like, well, if my money grows at 9%, as long as I take out a little bit less than 9%, right, I should not erode my principal because I'm just taking the earnings and the growth out. Guess what? The market has never done like exactly 9% every year. It's up 20, it's down 10, it's up 5, it's down 7, it's up 30, right? So depending on when those returns hit your account means everything as you're taking dollars from the account. Everyone might know of dollar cost averaging. You're putting dollars into your 401k plan. As the market goes up and down, as you're saving, that actually helps you. You like volatile markets because when the market goes down, you're buying more shares, right? That's good. You want more shares because when the market goes up, you have more shares to take that lift up. But when you're taking money out, it's called reverse dollar cost averaging. So the sequence of return risk is that now I'm retired, the market's down, and I'm taking dollars from those portfolios could absolutely blow me up.
Well, and it's why we say that when you're in retirement, when you're taking money out of your portfolio, make sure you have enough safety so you're not taking out of the market. You can let the market do its thing and recover. Another issue is, are you taking the right amount out of your portfolio? Sometimes you think, well, I'm making 6%, so I can take 6% out. Well, you're forgetting about inflation. If you do that, you're going to run out of money a lot more quickly. You know, a lot of people, including us, say 4% might be a way to think about it. It depends. It depends on a lot of factors. It may be less, or it could be more. Let's say you're older when you start taking money out, it could be a higher percentage. Just make sure you've got the right plan, you're taking the right amount of money, you've got the right investments.
All right, start planning, folks. You need our help? Go to yourmoneyyourwealth.com, click on our special offer. It's that retirement readiness guide. Get ready for retirement. If you're in retirement 5 or 10 years from retirement, just starting to save, this guide has it. Go to yourmoneyyourwealth.com, click on the special offer. It is called our retirement readiness guide. We got to take another quick break. We'll be back in just a second.
Do you know right now how likely you are to run out of money in retirement? There's an easy way to find out. It's also free. Go to easyretirement.com.